I'd like to take you through the institutional investment thought process. And this could also be applied to a personal portfolio, but let's look at it really from institutional portfolio point of view for class purposes. So let's say you have a pile of cash. One question that might come up is, how fast can you spend it and not run out? And of course, what should you do with it and how should you invest it? So if we believe that we can achieve long-term returns similar to a typical pension plan's assumptions, that means that we can expect 7 to 7.5% annual returns. That's the ballpark of what most pension plans assume. And that might be a reasonable assumption for a personal portfolio over a long period of time, taking reasonable risk. But those return assumptions include roughly 3% per year for inflation. So if we withdraw and spend 4% per year, the purchasing power of our portfolio should remain constant over time. So in other words, if we have $1 million today, and 20 years from now, we should be able to purchase roughly the same amount that $1 million would purchase today. So those assumptions are something like a real investment return of 4%, inflation of 3%, for a total return of 7% per year. So does that mean if we have $1 million now and want to live off the investment returns and the purchasing power of our portfolio doesn't decline, we'd have to live on $40,000 per year? Yes, actually it would. $1 million doesn't go that far anymore. So should you have lots of diversification, a little diversification? Should you spread it around over everything in the world, or stocks and bonds and cash? Is that kind of the way to go? Well, correlation, not the number of assets, is the key. If all of your assets are correlated to each other, the diversification value isn't so great. So what's the process? What does the smart money do? What would a pension plan do, for example, or an endowment, or a wealthy family with a lot of money? Even if equities are only 40% of your portfolio, most of your risk is still in equities. Equities are actually quite volatile. So as shown here, the risk from equities is very large, even for a portfolio with only 40% in equities and 60% in bonds. The value of many investments are correlated to the equity market. Real estate, for example, is very highly correlated with the equity market. You have basically two options in investing. One is to own it, to buy real estate, to buy equities, to buy other assets. The other thing you can do is loan it. You can buy debt. You can make a loan. Essentially, that's what debt is. A loan to the government, buy treasury bills. Those are the two basic categories that you can invest in. The value of the U.S. stock market is highly correlated to a relatively few large companies. As you can see here, 34% of the U.S. companies comprise over 90% of the U.S. stock market. Globally, you have had a large growth in the value of non-U.S. companies. So you can see from even 1999 to 2009 that the total value of U.S. companies has shrunk from 53% to 40%. That's a big outperformance by foreign companies, and that's brought investors' attention to global companies a great deal. So how much do you decide to put in each asset category? The standard response would be, for an institutional investor, would be something called mean variance optimization. Basically, you're going to use an optimizer to try to allocate to various asset classes. Now, there are downsides to using mean variance optimization and optimizer, and some professional investors are very against it, even though they may use it as part of their process. The asset classes are difficult to define and isolate. Is real estate a separate asset class? Is it really more of an equity asset class? Because a real estate investor owns, just like in a company, everything over the debt, and almost all real estate is mortgaged. So there's a lot of correlation there, a lot of similarity there. But let's go through the process, and later you can look at this list of issues, or I'll highlight at least some of the issues as we go through. The first thing you would do is have assumptions for returns and risk for each of your categories. And here, for example, we show U.S. equity. We expect 8% returns over the foreseeable future, the long-term future, but with a standard deviation of 15%. And that would compare to fixed income, which we expect to have a 5% return and a 6% standard deviation. So quite different risk and a lower return for fixed income. We'd also have a table of correlations. These are the inputs that we would send into the optimizer. How correlated are these asset categories? And we'd have constraints because we don't want to put all of our money in one single asset category. If we simply look back at expected return and let's pick one that's pretty high here. Let's see. Well, alternative investments, although their standard deviation is high too. But if you have an asset category that has a high expected return and a relatively low standard deviation to that expected return, well, what's an optimizer going to do? It's going to put all the money there. Put all the money in the high returning, low risk strategy. Well, you don't want to do that. Not just blindly anyway. Well, you don't want to do that, period. Because it's putting all your eggs in one basket, so to speak. All your risk is in one category. And even though you expect that category to have the highest return, all your risk is in that one category. You just don't want to do that. It's not a reasonable thing to do. So you want to set constraints. But as soon as you set a constraint, and in this category, the maximum specified constraint for real estate is 12%. Well, if real estate turns out to be a high return, low risk area, it's going to go to 12%. So who set the 12% category? You have, not the optimizer. So you really have to look carefully at what you've set constraints to. It's not a perfectly scientific process. What you do end up with is an efficient frontier, and you've probably seen this from prior courses. And you can change your asset category mix, and it'll put you somewhere on this efficient frontier, which is the line that would show the optimum portfolio given a risk and return. So here we can see the mixes for different optimizer outputs. So here we have the current portfolio, the actual portfolio. So the current portfolio is the policy portfolio, what has been determined to be the target. And of course, the market moves every day, value changes every day. So this is the actual portfolio that this pension plan had. I believe this is the San Francisco pension plan. And 4 possible target portfolios that come out of the optimizer. And you can see those 4 portfolios plotted on the efficient frontier here. So the recommended results from the mean optimization are here. And the mix of the 4 that was selected by the investment committee was mix 3. So this increases the equity ratio. It has other impacts here, as you can see in this list. But basically, the summary shown here, diversification reduces risk more than it reduces return. That's the target. Some risk you can't diversify it away. That's market risk. But by increasing diversification, you can reduce some risks. The optimizer is a tool. It gives you a number of answers, not just one, quote, right answer. But use the tool with constraints and use it with common sense and in careful judgment. One thing that really all plans will use is the tool of rebalancing. And if you have a target for 50% for a particular asset category, and that asset category runs up in value relative to the others, so for example, stocks outperform and you've allocated 50% for stocks, let's say they get to 60%. Well, usually people will use that as a target to rebalance. Sell their stocks from 60% allocation to 50% and reallocate that money to the other asset categories. And in a similar way, if stocks underperform, so that your asset allocation to stocks declines from 50% to 40% because they've done terribly, and this isn't something you would intuitively automatically do, you'd want to buy more. They've done terrible. I'll buy more. Well, what that does is it brings it back to your target. And if you think about it, what it really does also is sell high. Stocks have run up a lot, sell them, and when they've underperformed, they've done very poorly, buy them so that you're selling high and buying low. That's the idea. And it's not an intuitive concept, because naturally we want to hang on to our winners. Well, at least some people would want to hang on to our winners and just let them run. And that does have actually some rational basis. But what the rebalancing process will do is force you to sell high and buy low. And here's an analysis that looks at rebalancing, and looks at results over a period that are rebalanced versus not rebalanced, and it shows about an improvement of results because of the portfolio being rebalanced. So what could go wrong? We don't live in a normal world. What I mean is a world that behaves in a statistically normal way. And normal variation is what optimizers assume, and is what most statistical approaches assume. If returns were normal, statisticians would expect the S&P 500 to move up and down by 4% or more once every 10,000 years. I'm sorry, once every 100,000 years. But in fact, we've had 78 of those occurrences since 1950, and nearly half of them in the last few years. And this is a few years from 2010 when this particular slide was prepared, so a few years ago. But clearly, we have unexpected events more than one would expect in the investment world. So if we look at the September 2008 crash, the probability of dropping 9%, more than 9% in one day was extremely low. But nevertheless, it happened. It's not that statistics don't work. It's just that financial markets don't lend themselves to be predicted precisely in that way. So let's look at putting Citi into practice. When I was on, or I'm still on at the time of making this recording anyway, the board of the San Jose Pension Plan, we looked at a long-term asset mix shown here, where we had a current mix of 25% in public and private debt, 60% in equity and real estate, and we're lumping them together because they're very highly correlated. They have similar behavior. Absolute return strategies of 5% and real assets of 10%. And real assets are assets that respond to inflation. So, for example, timber, real estate sometimes is put in this category, farmland, commodities, those and energy. Those sorts of assets tend to go up when inflation goes up, and also tend to generate returns when inflation is not going up abnormally. But when inflation goes up, they go up a lot. So it's a hedge to inflation. So that was the current category, asset category allocation at the time that this was looked at in 2011. We're going to use some graphs, and here's how the graphs work. The percentiles are divided into 4 categories, shown here, a blue color, light blue color, turquoise color. For the highest percentile, the red is the next percentile. The 50th percentile, where you'd expect to be half of the time, is where the red and yellow meet, and the lowest quartile is the blue quartile. So that's how the